So things aren't looking rosy for the world's biggest economy. Now, ever since the trade war started, the outlook has been just downright horrible. GDP estimates from the Federal Reserve themselves shows the US economy contracting by 1.8%, and this is from a 2.3% growth last year, and it shouldn't be a surprise. When you cut down government spending amid a tariff war, you have to expect people in the US to spend less. People domestically are very concerned about what's coming in the next 12 months. The only thing rising is people's anxiety. Consumer sentiment is plummeting back to the lows in 2022, and that's bad for company earnings as people just don't have the confidence to buy stuff. And why is that happening? Well, inflation expectations for the long term just flew to the moon. We are now at 3.9%, which is the highest reading since 1993. People on the street, they aren't stupid. They know what tariffs entail. Their purchasing power will get eroded. So people, they are bracing for impact. They will be cutting spending today to prepare for prices to go higher down the road. And that's just on the inflation front and the US economy in general. But when the fundamentals starts to collapse, this also hammers down on the stock market. Now, are stock prices important? Yes, especially for people living in the United States. The reverse wealth effect could drive consumption down even further if the S&P continues to collapse. Now, never before have US households been so exposed to the stock market. Over 60% of total assets are piled into financial instruments. Cash holdings are below 30% and bond holdings are well below 10% as well. This spells doom for people should the markets continue to correct down. They don't have spare money lying around if an emergency happens. And in a twisted way, the strength of the US economy is highly dependent on the stock market staying strong as well. So if you're Scott Bessent, you can't afford things to get worse. The US Treasury is trying to attempt a very dangerous gamble with the economy, shifting spending from the government to the private sector.
I'm a deficit hawk, but we are not going to be able to do this all at once. We are left with a terrible situation, 6.7%, 6.9% deficits to GDP, and we're going to bring this down slowly, reprivatize the American economy, reinvigorate the regulated banking system and the private sector.
And as Besson said, this shift has to take time, and he can't afford any shocks to the system, which means he still needs the world to fund the US government at cheap rates. But that isn't happening according to plan. We are seeing the repudiation against US assets escalating. Foreigners are continuing to dump US treasuries in 2025. This isn't just a one-off event. Countries and overseas investors aren't buying what Trump is selling. They are selling off their holdings for the third straight month. But the details of the sale is very important here. In January, an additional $13 billion of US bonds were dumped. Now, these aren't your short-term T-bills. These are long-term treasuries of 1 year maturity or more. Since Trump got elected, almost $100 billion of long-term US bonds were sold off, and this shows a lack of long-term confidence in the US economy. Remember, this is before Trump went wild, he went ham on the world with his trade wars, and this was before he went crazy and started imposing tariffs like no tomorrow. Now, tariffs increase the threat of inflation, and when prices goes up, without additional productivity, it hammers down on US growth. Investors expect the worst, so they start dumping US Treasury bonds. This situation is something that Bessent just can't afford. He has said many times that the debt situation is out of control and the US economy is still strong. Now, he alluded to avoiding a recession and getting the national debt under control, but he might get none of these things. Over the last 80 years, government spending has become a key driver of the economy. Government expenditures now account for 34% of US GDP, compared that to just 20% in the 1940s. Despite what Bessent says, the US will still need to issue a tsunami of bonds going forward, and in 2025, this won't suddenly change. The amount of money he will have to borrow will be mind-boggling, and you probably want to sit down for this one. The CBO is projecting a $1.9 trillion deficit for the fiscal year of 2025, and that's 6.5% of GDP, which is actually on par with Biden's final term. It's unsustainable. But what's important is the need to keep bond yields as low as possible. If Trump wants to reshore production without imploding the US economy, he needs to keep interest rates as minimal as possible here. Now, on April the 2nd, he will be imposing his reciprocal tariffs on the world, and that alone will spook out people in the US. Prices could jump higher within a couple of months, but yet the White House, they are promising the world the impossible.
He's the president of the United States of America, and he cares about American workers. And that's who he's here to protect. And all this other nonsense has got to go. Because the fact is, the stock market is going to be much, much higher. Much, much higher. And you know what? If they're worried about this change, they're foolishly betting against Donald Trump.
But if foreigners keep dumping long-term bonds, this poses a real problem to the economy. The entire system is a function of interest rates, especially the 10-year rate. At 4.3% yield today, the real economy is paying between 6 to 8% for their loans. Mortgages and car notes, they are all affected by this. The more countries refuses to buy long-term bonds, the more pressure this piles on the system. Borrowing costs would stay elevated for longer. And that's why Trump's trade war is just so dangerous. Not only does it increase prices for domestic consumers, it also pushes the world into a corner, and that invites retaliation. Now, so far, we have seen countries hit back with their own version of tariffs. China has also imposed export restrictions, but things could get nasty if a hitback targets the US bond market. And guess which G7 ally dumped the most in January? It was Canada. Investor holdings dropped by nearly $30 billion, and this was in January before the trade war started. It really pushes countries to the max to diversify their trade away from the US. This is especially scary for the US Treasury if they trade more with countries in the BRICS, especially China. Now, global trade is denominated in dollars, we know that. But as the US goes inwards and decides to manufacture everything themselves, they will import less. Countries that retaliate will also impose their own tariffs on US goods, so their consumption goes down as well. They will have to import from elsewhere. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one-stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SEANFOO. Start your gold stacking journey today. Now in 2024, China's cross-border trade increased by nearly 15% to over $14 billion worth, and more than half of this was settled in the Chinese currency, the RMB. That means a lesser need for countries to hold more reserves in dollar assets, including US bonds. This is a big side effect of Trump's trade war few people are really talking about. It's also not just China contributing to the chaos in the bond market. Now, thanks to Trump pulling out of the EU, threatening to escape NATO, Europe now has a fire lit under them. The entire bloc, especially Germany, has a big urgency to boost economic growth. And the quickest way is to borrow money and deficit their way out of this. Deficit spend their way out of the crisis. And the implications are huge for the future of the US bond market. Investors now believe Europe's economy will grow. As a result, we have seen this incredible appreciation in the euro versus the dollar. In other words, investors they are selling dollars to buy euros to buy EU bonds. Investments in the global economy is more or less a zero-sum game. If more money flows into Europe or China, the US is denied cheap capital, which ultimately means Bessent needs to offer a higher yield to get investors in. Basic supply and demand here. Now, the world moving away from US trade would also hammer on the growth of American companies. When companies want to expand operations, they issue debt. They borrow money at, say, 6% because they believe their business will grow at 10% or more. But if US growth is expected to stagnate, companies will issue fewer corporate bonds. The US corporate debt market is the largest in the world, much bigger than China and Europe combined. So investors, especially the big money managers, they have no choice but to pile into them. The US market is large enough to absorb the demand. But if the trade war rages on, China and Europe will be forced to stimulate. Their companies will need to grow and issue their own corporate bonds in their local currencies, essentially more RMB and Euro bonds. And that competes with US corporate debt issued in dollars. There will be more competition, which means American companies need to sweeten the deal for investor money. Yields will have to go up. So we have to appreciate more about the knock-on effects of this entire situation, this trade war. But it isn't just RMB or Euro bonds that will benefit from Trump's tariff war. The universal store of value, gold, will be a winner for many years to come. Now, what Trump is doing won't just drive buyers into EU or Chinese bonds. Central banks and investors are still buying into gold despite record prices. And it's thanks to China once again. The PBOC just added more gold to their central bank reserves for the fourth straight month in February. China is facing a barrage of tariffs from the United States, a 20% additional tariff on top of earlier taxes from the Biden era. And if that's the case, the last thing you'll be buying are US bonds to help stabilize Trump's economy. You'll need to find a neutral reserve asset that Washington can't touch, or you might just end up like Putin, end up like Russia, losing $300 billion to the West. So we are now at another pivotal point for global gold demand. People are seeing the current world order get torn apart and it's a global flight to safety. And Beijing's gold buying is just accelerating the process. This is a chart of global demand for the last 25 years. In 2024, the world bought nearly $400 billion worth of gold. There were three pivotal points that saw gold demand just shoot to the moon. Now, the first was the bailout of Wall Street in '08 and '09. We can all remember that. The US printed and dropped a ton of money to save the system and basically devalued the reserve currency. Now, the second was massive stimulus in 2020, and we all knew what happened then as well. At least $5 trillion was added to the US balance sheet. Now, the third, of course, was the seizure of Russia's reserves 3 years back. The West, they went in, they froze and they confiscated away $300 billion in Russian assets. And there's a common thread that ties all of these events together, and that's the undermining of trust in the US financial system. So just ask yourself what Trump is doing today. Does it build trust in the system or does it erode away confidence? Imposing tariffs means cutting countries away from accessing dollars. Yes, it could cause a currency crisis short term, but long term, it will push countries away from dollar holdings. For the first time in 5 years, retail investors are now starting to buy into gold. North America, Europe, and Asia, they're all starting to pile into gold ETFs. It's a net positive. Demand is all going in one direction, which tells us a systemic shift might be here. Trump has managed to freak out the world, and we have no idea how long his trade war might last. If he's really serious about reshoring US production, this trend could continue for many years to come, and there's probably no off-ramp left. So let's sit back and just watch what Trump does. He seems hell-bent on this April the 2nd plan. And if he goes ahead with it, it won't be good for US bonds, won't be good for the dollar, but chances are it could be great news for gold. But let me know what you think. Will more countries start selling their debt holdings? And will China buy even more gold this year? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.